प्रेजेंटेड बाय ईबिक्स कैश। हर खुशी के लिए काफी है।
Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the headlines. Market snaps 4-day losing streak. Sensex ends above 61,000, led by banks and realty. Auto stocks drag. ICICI Bank zooms 11% after stellar quarterly numbers. Air India, another step closer to disinvestment. Government signs share purchase agreement with Tata Sons. Nykaa set to launch 5,352 crore rupee IPO on the 28th of October. Price band fixed at 1,085 to 1,125 rupees per share. Reliance to launch world's most affordable JioPhone Next before Diwali, reveals specifications ahead of launch. Seventh tranche of gold bond scheme opens today till the 29th of October. Government has fixed the issue price at 4,765 rupees per gram. Hotstar is the other winner in Sunday's India-Pakistan match. Over 1.2 crore viewers watched the tie on OTT as rains disrupt DTH services in the north. Markets remained erratic and volatile on the first trading day of the week. Sharp moves were seen in the benchmarks, with the Nifty trading in a band of 280 points, finally settling marginally higher at 18,125. That's gains of just about 10 points. Sensex closing at 60,967, up 145 points for the day. The star performer was the banking sector, with the Nifty Bank up over 2% to settle comfortably above 41,000 in trade. ICICI Bank surging over 11% after a better than expected set of Q2 earnings. The top gainers of the day were ICICI Bank, that's up 11.5%, Axis Bank, ONGC, Tech Mahindra and JSW Steel. Most of the other indices, including realty, auto, consumer durable, telecom, IT, all ended with losses. Top losers included BPCL, Bajaj Finserv, SBI Life, Bajaj Auto and Tata Motors. Broader markets extended losses, with the S&P Mid-Cap Index and Small-Cap Index ending with sharp cuts of 1.65% and 1.76% respectively. The India VIX also ending marginally higher. In trade today, 17.61 is where it closed. Let's go across to our global business editor, Udayan Mukherjee, to understand what he's making of the markets. And Udayan, after a week where we finally thought we were starting to head into a consistent period of profit booking, we're back and with a bang. What are you making of how things stand and what's in store now going forward?
You know, Abha, this market is surprising everybody. You know, as you said correctly, that every time there is a 2-3% kind of a pullback, all of us sit up and say, okay, maybe there is a big correction finally happening. The market just rolls with the punches for a day or two, and then it starts to roll on higher. So, you know, it's very, very difficult. It's going to be very difficult, almost impossible to call and time this correction, because the market is just not obliging all those correction calls. And also, if you look at it, the kind of reactions that we're getting from earnings, I think the market's playing it quite fair. I mean, that after the TCS results, the stock corrected and the sector corrected because the market was not very happy with the results. And you saw the kind of response we got from an ICICI Bank results, where the stock was up more than 10%. So these are legitimate reactions to results, which tells you that the market is in a fair judgment kind of a mode. It's not being excessive or over the top. Also, the fact that when a market is very tired, usually good earnings will not see very rapturous reactions. The market would have priced it in already in advance, and stocks don't react by going up after even good earnings. That is not happening with a couple of the marquee names which have come out over the last few days. And that, I think, would be received quite well by the bulls. But I think, having said all of that, if you are an investor or a trader, I think right now you should adopt a kind of what I call the footboard mentality, which is basically you're riding a train, ride along, but stay on the footboard, because at some point it looks like there might be a small accident and you should be close to the exit door so that you can quickly jump off to the platform. So I think it's a footboard kind of a market for the moment. It's chugging along. You don't want to leave the train yet, because even 2 weeks out of a market like this could leave you short by 10-15%. So you want to stay in, but I think you should be cautious and participate very cautiously and stay close to the exit.
So that's really how the markets stand right now. But then, as always, we have a special guest with us this Monday on our Market Guru chat.
Our guest today on the show, an old-timer from Dalal Street, Ashwini Agarwal, partner of Ashmore Investments. Ashwini, it's great to see you again. And it's been such a remarkable market in many ways. I mean, it gives you this feeling periodically that a big correction is finally beginning to start, but it just takes a few knocks and it's never more than a 5% dip, and it just continues to move ahead. Do you think we can roll on like this for much longer, like just consolidate periodically and move higher and higher? Or do you think one of these corrections will turn out to be the real one?
So, Udayan, good to see you again. Great question. I was just tabulating. It's the longest increase or uprise in the market, or a rising trend in the market without a meaningful correction. It's almost 18 months old. From the lows that we saw in March 2020, we saw, a correction, whether you can call it meaningful or not is debatable, but we saw a correction, let's say from the 30th of April 2020 through till 17th or 18th of May 2020. But since then, and it's 18 months, almost 17 months, we haven't seen even a single double-digit correction. And since 1992, I don't think we've seen a single uptrend which is so long and so powerful with no pullback. So obviously, it feels that the party can go on forever and there's nothing wrong. And to be certain, the top-down news in India is actually quite energizing and quite positive. But as you mentioned, I'm an old-timer, and when I look back at the trend that I've seen through 30 years of investing, it just seems unreal. And I think that there should be a correction. There will be a correction. When and how much, I don't know. But are things lining up to expect a correction? I think so. I think there are factors that are starting to worry me. So just to name a few, very early in my career, I was taught by a market veteran that markets are all about demand and supply, just like any other market. It's demand and supply for paper. And we've seen $9 billion of new IPOs already this year. We've probably got another $2.5 billion being raised in short order over the next 3.5 weeks. And every successful IPO, in my view, is encouraging more such offerings to come through. In terms of demand, if you look at the foreign flows, there is no incremental net new investment coming through for a couple of months now. Even the participation in IPOs is being funded from sales of existing positions, as it would seem. Local mutual funds are definitely seeing a huge amount of inflow from investors, but how much of that is coming into the market is a question mark, because the net purchase figures from mutual funds have also been fairly soft. So I think, the demand-supply equation is starting to get a little worrying, at least, the way I look at it. Second is that the earnings season so far isn't giving you a positive momentum to earnings revisions. So when P's are already high, you need earnings revisions to hold the market up. And that hasn't come through. Banks, of course, you're probably going to see some positive momentum and some positive revisions. Tech a little bit, but outside of that, there's really nothing. So, if you think about it in terms of demand and supply, a correction looks potentially possible. And in terms of earnings momentum and valuations, a correction looks possible. We will have to see how and when it pans out and what's the event that triggers it. But these are the fundamental factors, in my view, and the technical factors, in my view, that one has to think about.
Right. It's interesting that you mentioned one technical factor, demand supply, and one core fundamental issue, which is earnings. But as you well know, that sometimes these factors by themselves, while they may portend a correction, they may not precipitate one quite as soon as you imagine it may come about. Sometimes it needs a different kind of a pin to prick the bubble. So my next question is, what do you think is that event which can then bring these fundamental and technical factors to bear on the correction that you are suggesting?
Udyan, having seen several of these events over the last 28, 30 years, the event which will precipitate the correction will be known only in hindsight. We will not know what caused it. We will not be able to see it coming. We can guess what this might be. It might be increase in interest rates. It might be inflation prints. It might be energy costs. It might be foreigners suddenly turning panicky. Who knows? It might be a corporate blow up of some kind that we can't imagine today. But usually, the truck that rams into this bus is not visible. It's usually coming around a corner and you don't see it till it's upon you. That's the reality of markets. So, the way I think about it is that yes, the momentum is strong today and everybody's looking to buy. And, you could argue that the top-down picture in India is looking extremely interesting and energizing. But I think the fundamental and the technical factors are starting to point in the other direction. Now, how long does the rally continue? Will you see another 10% up on the Nifty before I'm right, or I'll be laughed out of the room because the Nifty will be 30% from here? I don't know. I can't predict these things. But what I can tell you is that India is more expensive today on historical PE basis than it was back in 2000, which is the most expensive I have ever seen. Fortunately, I was not around when the Harshad Mehta boom took place in early 1992. I joined the business in June 1992. But in my memory, I have not seen valuations at these levels. With valuations at these levels, rates looking to go up, inflation being on the higher side, earnings momentum slowing down, I can't for the life of me see what will allow the party to continue. Yes, more and more retail participants can continue to come in, more and more money can continue to flow in. In the short term, I may be wrong, but that's fine. We've seen this before. So I think, if we recognize the different ingredients that go into the mix, several of them are pointing in a not so positive direction. The top-down story is very energizing. I mean, the government's doing the right things. The policy noise is absolutely great. There are no macro imbalances in the economic system, unlike in 2013 or back in 2000 or 2001 or 1999, where the fundamentals were in face of very, very challenging macro economic backdrop. This time around, that's not the case. So I think the macro story is very interesting. You'll probably see real GDP growth accelerate from here for the next 2 or 3 years. But I think the market's been quick to discount what's up ahead in terms of the fundamental story, which is why I worry.
Catch more of that interview with Ashwini Agrawal of Ashmore Investment Management on businesstoday.in. Now, it's festive season and tradition says it's time to buy gold. In fact, if you're interested, it could be the right time with the government opening subscription to the latest gold bond scheme today. But with other options available, is it really the best fit for you? Let's take a closer look.
Out to buy gold or gold jewelry this festive season? You have an option in gold bonds as well. The latest tranche of gold bonds opened Monday, open to investment just for 5 days. The issue price has been fixed at 4,732 rupees per gram of gold. And if you pay online, you get a discount of 50 rupees per gram. The interest rate on these bonds is 2.5% payable every 6 months. You can buy any quantity from 1 gram to 4 kilos. The tenure is 8 years with an option to exit after 5 years. There will be no capital gains tax if the bonds are held for the entire 8-year period. The annual interest, however, will be taxed. You can buy these bonds from banks, NSE, BSE, SHCIL, CCIL and designated post offices. The bonds can be bought and sold in secondary markets.
So gold at any given point in time is a good investment. as it gives a very good hedge to your overall other investments portfolio. One can actually look at parking 5 to 7 or 10% in gold at any given point in time. Last 1.5 year returns have not been that good, but on an average, gold has given an excess of 8 to 9% return in the last 15-20 years.
Well, if you have watched the India-Pakistan match, you must have observed that the major advertisements in between were talking about the cryptocurrency investment. And why not? Because it strikes this big debate that what is a better investment option? Is it the stock market investment? Is it this new age cryptocurrency investment? Or is it the old age investment into gold, especially during a time like Diwali, where it has been a conventional norm to invest in gold?
Gold as an asset class has not been the best of investments. Over the past 1 year, it has fallen more than 5%. You would have been the luckiest if you had invested 3 years ago. Compounded returns over 5 years are around 7% and over 10 years at just 0.5%. Gold, however, has given a steady return of 9.7% over the past 20 years. For the investor, the most liquid options include bank fixed deposit with an average return of about 4.5%, government 10-year bonds at 6.3%, balanced mutual funds at 10 to 30%, and pure equity funds which have given returns of up to 85% in the past 1 year. The X factor for investors is obviously cryptocurrencies, which, although not legally allowed in India, have their own legion of fans.
SGB as an asset, you could trade it on the market in that sense. You could, pledge it to get a loan. Some of these items are not available for crypto because, first of all, it's a very new age asset class. So it does not really have any long-term track record, and also not that accepted or regulated in many parts of the world.
Analysts, meanwhile, are suggesting interested investors buy the gold bonds in installments to spread the price risk. Also, with stock markets at unprecedented highs, more and more analysts are recommending hedging the bets by increasing the portfolio allocation in gold. Bureau Report, Business Today Television.
Reliance Jio is finally set to launch the much-anticipated JioPhone Next this Diwali. The handset, developed with Google, was to be launched on Ganesh Chaturthi last month. The company has revealed some features of the pocket-friendly phone, which will run on Android-based Pragati OS. Some of the key features include a smart camera, which supports various photography modes and is preloaded with filters of emotions and Indian festivities. Pragati OS will ensure optimum performance while ensuring long battery life. To enhance the user experience, voice assistant, read aloud and translate features have been offered in the device. Market regulator SEBI recently gave the green signal to the initial share sale of Paytm, clearing the way for one of the biggest IPOs in India's history. The Vijay Shekhar Sharma-led company is planning to raise 16,600 crore rupees, with the issue expected to hit the street before Diwali.
It's a scene from 3 years ago at Vijay Shekhar Sharma's office. This was the same time when legendary American investor Warren Buffett invested in Paytm. At 16,600 crore rupees, this promises to be the largest IPO in India so far, surpassing the 15,199 crore rupees issue of state-owned Coal India in 2010. Speaking at that time with Rahul Kanwal on Jab We Met, Sharma had said,
"It's inevitable that the model of financial services on internet and technology is showing up in other countries. I mean, China is definitely one of those big numbers showing up. So there is a tremendous amount of cash flow that can be generated based on the business model that we know."
Today, with Paytm on the cusp of a public listing, it will not just be Vijay Shekhar Sharma, but a host of investors who will break out into a song and dance as they eye a cash out of the firm that epitomized the startup dream for Indian entrepreneurs. And the rise of the digital age with the advent of demonetization. While the company has not finalized a timeline yet, it is expected to list on the Indian bourses ahead of Diwali. Reports suggest that the company could list by the end of October, as it plans to skip the pre-IPO share sale rounds to fast-track the listing. Experts are quite bullish on the IPO and expecting a blockbuster listing despite the high valuation.
This will be a blockbuster IPO not only for the Indian capital markets but even for large as well as retail investors who want to invest in a fintech company for a longer term perspective. Most importantly, listing gains could be definitely be significant, and thereafter, of course, the company's performance, its quarterly numbers, and what kind of performances it records, on a quarterly basis, are going to be, the near-term tailwinds which would, drive the valuations going forward. So definitely, even though company is loss-making, I would not be surprised if this issue gets a very strong kind of response from the markets.
According to sources, the Vijay Shekhar Sharma-led company is seeking a valuation of $20 to $22 billion in the IPO. Bureau Report, Business Today Television.
After the trailblazing Zomato IPO, another Indian startup is set to debut on Dalal Street. The IPO of well-known cosmetic e-tailer Nykaa will open on Thursday, October 28th. The company expects to raise 5,352 crore rupees. The IPO will consist of fresh stock and also an offer for sale by existing shareholders. Promoter Sanjay Nair Family Trust will sell 4.8 million shares. Other private investors who are likely to sell stakes include TPG, Lighthouse India Fund, JM Financial and many more. The price band for the IPO will be set between 1,085 to 1,125 rupees. Founder Falguni Nair and her family will continue to own a majority stake after the IPO. As per reports, post-IPO, the promoters will hold 53% in FSN e-commerce ventures. Let's hear out Falguni as she explains why the company chose to list in the public market.
We have a large shareholding, besides the promoters, there are a number of shareholders from high net worth families, as well as some funds who own company shares. And we believe that taking it on a path to listing with a, long-term sustainable, presence and life of its own in the capital markets was the best way to allow investors to enter and exit the stock when they need to.
Two big financial sector bills are expected to be tabled in the winter session of Parliament, expected to begin next month. According to reports, the first could deal with amendments in the Banking Regulation and Banking Companies Acts to enable privatization of PSU banks. Finance Minister Nirmala Sitharaman had announced the government's plan to privatize 2 banks and 1 general insurance company in this year's budget. The second bill split the National Pension System Trust (NPS) from the Pension Fund Regulatory and Development Authority (PFRDA) to ensure universal pension coverage. That's where we leave it on the show today. Thanks so much for watching.